Retracement concepts. Retracements are also known as Fibonacci retracements, but as you'll see, this is not how we are going to use it. We do not use retracements for locating support, resistance, or indicating trend changes. We only use price for that. Fibonacci levels or retracements attempt to predict support and resistance levels. Many base trading decisions on this kind of analysis, and it can become a self-fulfilling prophecy. These levels are typically used are 38.2, 50%, and 61.8. Anytime trading is tried to define within a decimal point, we say it's really an attempt to try to find the Holy Grail, and it's not producing the proper mindset that a trader wants to have. Reversals at these fib levels occur when they're in alignment with supply and demand, just like moving averages and trend lines. Realize it's the distance between these areas of supply and demand, or support and resistance, that determine the potential level of retracement, not lines drawn on a chart. We want to keep our analysis of support and resistance based on prior price areas, not projections of a subjective analysis tool. Here's an example how someone using Fibonacci analysis would be looking at these points of reference as turning points. And you see on the chart on the left where it was measured from the pivot low at that bottoming tail to the prior high, and then the pullback toward the 50 to 60% retracement area was right in alignment with that congestion of price candles. Of course, it was the price candles that stalled prices from pulling back at that time and the reversal back up again. That said, those using the tool will also come into play as they place their trades based on this subjective analysis. But understanding that it's actually the price congestion area that's causing the reversal is key to understanding price movement. With the slide on the left, you see the advance off of the low stopped in the area of the 382 retracement level, which is where it was getting close to that prior area of congestion. And as it moved up to 50%, there was the pivot high over there to the left. And then eventually, as it continued to move higher, it did not even stop at the 618 level, as there was nothing there to the left to stop it. And then prices eventually moved up toward those prior highs. And there will be times when enough of these users of the subjective analysis tool will create reference turning points at those reference points. But you're going to see these turns occurring by just watching the candle action at that time. I'm going to use this retracement analysis to objectively measure the strength or weakness of a move counter to the prevailing trend. And we're going to use the most recent pivot points between each other. We'll take the most current pivot high and the most current pivot low, measure the distance between the two, and then see how far prices retrace from one point to the other. This will suggest the continuation of failure of the prior move. The level of retracement into a prior point of supply and demand are going to suggest the odds of moving through it. In other words, as prices move further toward an area of major resistance in a downtrend into it, the greater the odds of moving up through it. And in an uptrend, the further prices retrace toward major support, the greater the potential to move through it. Prices should not retrace 100% of a prior advance or 100% of a prior decline. These levels of retracement also give us insights into longer time frames. The deeper the retracement, the more bullish or bearish the pattern becomes in the longer time frame. A 40% retracement is considered positive. A trend should continue in the preceding direction. It tells us that demand in an uptrend is strong, or supply in a downtrend is strong, and odds are high that prices in the uptrend will overcome the prior high, and prices in a downtrend will overcome the prior low. A 50% retracement. The trend is considered still positive, somewhat more neutral than the 40%, but the trend should continue in the preceding direction. As prices pull back by 50% of the prior advance, prices should stabilize and then continue in the original direction and take out the prior high. In a downtrend, prices retracing approximately 50% of the prior decline should stall and then continue in the direction of the downtrend and overcome that prior low. Now, retracement levels aren't the only type of analysis that we are going to focus on, and why we have all the various chapters in this seminar. So in this particular example, we see prices pulling back to the 50% retracement level, which is in alignment with a prior demand point over to the left. So we have an actual area of price support in alignment with that retracement level, and we have a changing of the guard and a PBS that triggers, but up above we have a rounding top. Now, this doesn't mean that the PBS cannot follow through and overcome that rounding top, but being aware of the fact that there is a rounding top there, we would look for a stall in momentum at that time as prices consolidate and absorb that supply at the rounding top. Though PBSs are going to have better odds of a new high when pulling back from pivot highs versus rounding tops. A 60% retracement, the trend is considered neutral, somewhat negative. The prior advance or decline is now becoming into question. Retracements of 60% or more in a shorter time frame are becoming reversal bars in a longer time frame. We say this is the key to understanding what's happening in multiple time frames. If prices retrace beyond the 60% retracement level, in the case of an upward trending move, it's starting to become a topping tail or a bearish changing of the guard, and vice versa in prices moving down. Prices retracing more than 60% in the time frame being viewed is beginning to become a bottoming tail or a bearish changing of the guard in a higher time frame. At A, retracement A was more than 60%, which was an indication of weakness. In a strong upward move, like originally seen on the left side of the slide, prices do not pull back more than 60% after an advance like that. If demand is truly strong, they're going to pull back about 40%, maybe 50%, and then they're going to move higher. The strongest stocks won't even pull back that much. They'll consolidate into highs and then continue to push higher. So when this stock retraced more than 60%, the odds have increased that they were going to retrace all the way back down to the prior low. And after the shallow advance, that's exactly what they did. At B, they failed to continue to move higher, and then we got a bearish chain of the guard and prices retraced down toward the low of the move. Now the analysis doesn't stop there. From there, we retraced from the low at 12 o'clock more than 60% of the prior decline from B. And again, just like in the example of the upward move, with the downward move, prices are rarely ever going to retrace more than 60% and then turn back down again. Typically, they're going to continue to move up toward that prior high level. And at that prior high level, if the supply is strong enough, then the stock will begin to decline again. In this example, it did not and continued to move higher. 80 to 100% retracements. Prices retracing 80 to 100% of a prior advance tells us that supply is strong. And this is either going to be a bearish changing of the guard or a topping tail in a longer time frame. And after an 80 to 100% retracement, the prior trending move is considered negative. Prices should not retrace 80 to 100% of a prior advance or a prior decline. That said, tradable retracements can occur from areas of support or resistance. These are typically going to be at areas of major support in an uptrend and major resistance in a downtrend. For us to trade them, right, we want them to be a clean, as referred to as a clean decline or advance. Meaning we want to see multiple bars moving, but the opens and closes are next to each other. In other words, we're getting fluid movements down toward those retracement levels, and then we would look for candle patterns suggesting a retracement against that prior move down. In the case of an 80 to 100% move down toward major support, or an 80 to 100% advance toward an area of major resistance. Here we have a 100% retracement down toward a prior low marked at the 1030 reversal period, note the potent change of the guard at the low, resulted in a 100 retracement back up toward the high. So the prior weakness was completely negated by the 100% retracement back up toward the high. Now at that high, we would anticipate sellers, and you can see this narrowing candle bodies indicating slowing momentum, signaling the pullback from there. Now with that prior strength having retraced 100%, this signals to us that there's the potential for a viable retracement or pullback. Now as prices pull back toward that 40 to 50% retracement level, we see momentum slowing, narrow bodies, and bottoming tail bars, these signaling a buy above their highs after the strength of the 100% retracement and the shallow pullback. From that point, we're looking for an advance above that prior pivot high. Now when we look at a pattern like this, our area of resistance is that second pivot high, or that second blue band there. We don't view these as a double top or a more significant area of resistance as two highs. It's the one high that has to be overcome, since the prior retracement was 100% into that prior high. This is a quality pattern of strength, a shallow pullback, slowing momentum, bottoming tail bars, and a PBS signaling a move above the prior high. 100% retracements. A retracement of over 100%, which takes out support, that demand area, or resistance or supply area, totally negates the prior move. Once prices retrace more than 100%, this often results in exhaustion of the supply or the demand and sets up a high probability reversal point. In other words, as prices pull back from a V type of top and then retrace more than 100% to take out a prior area of support, typically the momentum is going to stall soon after, and you're going to get some type of a reversal that then sets up a lower high and then a resumption of the weakness. Same with a strength move. After a retracement of more than 100% signaling strength, you're often going to get a pullback after taking out that prior high, and then as that pullback occurs, you will get a resumption of the prior strength and a continuation of the prior move. Now, a continuation of more than 100% reversal is going to be greater when the move begins from a base, a double top, or a double bottom. Now, thinking about why that occurs is that because when it takes out that prior area of congestion, in other words, after a breakdown from a base and a breakdown through that consolidation, that base is close at hand, and that supply coming into the market is more likely to drive prices down and get a continuation of that move. This is often the case with double top type patterns that take out the middle of the congestion prior to the double top, and the double bottom type patterns that overcome the prior resistance, which was the middle of the congestion that occurred during the double bottom. This slide displays about as perfect a buy setup as you'll come across. Pivot highs or V tops leave little supply at the high, so it takes less demand to overcome this type of a high. And we have the pivot high here noted by the blue ribbon over the top of that bar. Notice the double bottom that occurred prior to the advance. Note the bottoming tail bar. Think about what the bottoming tail bar was prior to completion. A large red bar. Buyers stepped up in the area of the prior low, and demand pushed prices right to the top of that candle, signaling the price higher. And when prices retraced over 100%, overcoming the prior high, then there was a shallow pullback of about 40 to 50%, which was in alignment of that prior area of congestion, noted by the blue dotted square. Note the bottoming tail bar, which was also a range expansion bar closing near the high, signaling a buy above that high and to look for prices to move above that prior pivot high. Also note, above the prior pivot high, there's a price void and nothing to stop prices from moving higher after overcoming the pivot high. So again, this is about as clean, a perfect type of pristine buy setup as you will see. And buying shallow pullbacks of 40 to 50% into an area of support after a changing of the guard is a low-risk professional entry. On this slide, we see a strong advance at the beginning of the day, and then at the shallow pullback area at A, which is at about the 40 to 50% retracement level, buyers began to step up there. Now, traders buying at that shallow level, we anticipate that there are those using Fibonacci lines to place bids in the market to buy at those levels, form those bottoming tails. And then the bearish wide range bar that occurred after that was their stops being hit and supply coming in to the stock. Now as prices retraced all the way down to the prior low, they broke below the prior low at B, right, which was your prior demand area, and there was a more than 100% retracement followed by a bullish changing of the guard. This often sets up a counter trend move at the time. Note the green line under the two bars with the relatively even lows just prior to the breakdown bar at that time. In another section, we'll look at this pattern just called a breakdown bar failure. Subsequent retracement was more than 60% of the prior decline. And when prices retrace more than 60%, they're likely to continue to move up toward the prior higher, move up toward that 100% retracement level. Now, in the next slide, we're going to look at the same stock in a 15-minute time frame, which will be on your next page. So while traders might have thought about shorting those topping tails at C, a greater than 60% retracement is an indication of strength and a bullish changing of the guard on the 15-minute time frame. So what might have appeared to be a shorting opportunity because of the topping tails on the 5-minute chart was only the noise prior to continuation of the strong retracement. Notice where the candle bodies are in the consolidation in relation to the large green candle here. Here you had the greater than 100% retracement back to the low, the 60% retracement and more back up off of that low, which was the bullish changing of the guard, and then the consolidation at the top of that bullish changing of the guard. Also note the last green bar within the consolidation closed on its high. Remember, bars that close on their high within a consolidation, when the preceding bars had tails, signal a continuation of the move. The angle of retracement shows us how a stock is recovered through time. Sharper angles with clean price patterns offer us higher probability reversal patterns. We define clean by fluid price movements where the opens and closes are in the same areas and we get a continuation of the prior bar's direction. With the example on the right, we have a more than 100% retracement with a fluid type move to the downside. Notice the bottoming tail bar that broke down under the prior lows, and then the green bar signaling the move higher, which closed at its high. The example on the left is one of a self-correcting uptrend. Notice the multiple areas of supply and demand. The reversals that form typically do not have the desired momentum. These are more choppy advances after a decline like the one seen, where it retraces into the void, making higher highs and higher lows, but never offering a high quality pattern to get on board that move higher. Typically, these type of patterns, once they retrace up toward that reference point of resistance, they roll back over again and the initial downward move will resume. M and W formation retracements set up the unexpected for traders. Traders holding positions during the strong first move expect continuation. This is followed by a shallow retracement. Typically this retracement is less than 40%. This suggesting strength of the move, which brings in additional traders that miss the initial move. This will form what appears to look like a PBS or a PSS within the trade. The failure to overcome the prior supply after the pullback of an upward move, or the prior demand, in the case of the prior downward move at the prior high or low, can quickly change the expectation of those traders. These are the type of double bottom and double type patterns that we're going to want to focus on. Here are different variations of M tops and W bottoms. Essentially what we're looking for with this type of a pattern is an initial strong move. So starting with the example on the upper left, we see a strong momentum move higher, which resulted in a changing of the guard, normal bearish type of changing of the guard that results in a pullback and a PBS. Now as prices move up toward that prior high, the expectation is for prices to advance above and beyond that prior high. Prices were in an uptrend, they had a shallow pullback. The pattern is suggesting a move higher, and this is why this type of a pattern sets up the unexpected. Now here we have a new high, which I've marked as a bonus. Now why that is the case is that prices making a new high bring in more traders committed to the move after making a new high. This followed by a potent bearish changing of the guard. So at this point, long traders are caught and they will begin to exit those long positions, and this is the type of double top that could retrace all the way back down to where the move started. Few are going to want to buy this type of a pattern, and the failure is going to be bringing in supply to drive prices lower. With the example in the middle at the top, we have an area of congestion. The prices have broken out above that congestion, and then the middle of this M formation retraces deeply into that congestion, taking that area of support out as a reference point. The retest of the prior high formed a potent changing of the guard, this setting up a move down below the middle of the M top. Now the example on the far right shows the potent reversal on the left side, and then the right side is retesting that. So with these setups, you can either have potent reversals on one side or the other, or even on both sides. This can be combined with breakout type failures, potent changing of the guards, and topping tails. There's an endless number of combinations. I've just tried to show you a few here. Here are the W bottoms set up in a similar way. We're looking for momentum moves lower, changing of the guard, which sets up a PSS, which does not result in a continuation of the downtrend. We have a potent reversal back up again. Notice the new low that occurred on the lower left side of the slide, and a potent changing of the guard. This suggests a move higher up into the void above. The example in the middle has the congestion area. Now, this is a key point to note when you're looking at W bottoms and M tops. If they have congestion to the left, you want that middle part of the pattern to have retested and pushed deeply into that congestion to the left. And then when the pullback occurs toward that prior low, you're looking for bottoming tail bars, potent changing of the guards, some type of a pattern signaling that prices will retrace back up into the void above. Lastly, the example on the lower right had a potent change of the guard on the left, and then a retest of that low and the changing of the guard signaling a move higher. The example in this M formation does not have a momentum move higher. Rather, it has a gap up. Now, whether it's a gap or a momentum move higher, the common factor here is that there's no support underneath. So as this pattern began to move higher, note the topping tail on the left as it broke out to a new high and then began to pull back. This breakout and topping tail is a short-term warning. So this is not the cleanest type of PBS pattern that we'd be looking for, but it will bring in buyers. As prices moved up toward the topping tail, we know that there are going to be sellers there. The bearish changing of the guard is a potent reversal down, signaling that prices should move lower. This is a shortable event under the low of the changing of the guard. You also have a second setup where there's marked as reversal failure. So as it moved down under the middle of the M top, you got a bottoming tail, which then resulted in a reversal right back down again. Right, so that potent reversal down, right to the right of the red arrow, showing reversal failure is a secondary signal indicating that prices are going to move down into the unfilled gap. Unfilled gaps do not always stop moves. While we look as an area of an unfilled gap as a reference point of support, it's not a reason for long trades. So as prices move down and close that price void, your first signal that demand, if it's coming in, is beginning to overcome supply at that time, would be a move above a prior bar's high. This W retracement forms with increased volume at the lows. We actually looked at this slide in the volume section. Note the climactic volume at the first low with the slowing momentum bar, the narrow bodies, followed by the green changing of the guard on committed volume right at 10 o'clock. As prices retraced up and then pulled back from a shallow retracement, retesting the prior low, we have a doji bar, right, which is an indication that momentum came to a stop, noted by the first red diamond. Then there is a bullish changing of the guard, signaling your entry point. There's a bottoming tail bar. Right? We discussed this, where it had taken out the prior low, but then was able to rally up to the highs. This is a powerful pattern, signaling that prices are going to move higher. Notice prices move up through the 20 MA, and then when the doji bar forms above the 20 MA, the second red star, indicating that momentum is stalling at that point, but then continues higher. Right? The low of that doji bar is never broken. As you look to the left, you see that there's no overhead resistance. The resistance is up in the area of the prior supply point. And resistance is at the prior high, not the 200 MA. Those using 200 period moving averages often believe that prices will advance to that moving average, but the supply was at the prior high. Remember, MAs are only a guide. Retracement analysis is used to objectively recognize strength or weakness. We do not use it to attempt to locate support and resistance. The support and resistance points are right on the chart for us to see. We do not need any type of subjective tool to find it for us. And since those areas are right on the chart, knowing this makes subjective analysis tools unnecessary. 100% and greater than 100% retracements that begin from a V-top or bottom will have greater odds of reversing after a change of the guard. 100% and greater than 100% retracements that begin from a base, an M or W pattern, have greater odds of continuation. As we spoke about, those type of retracements are just starting. Right? Retracements under the bottom of an M top or up above the middle of a W pattern or a breakout of a consolidation are just beginning, whereas those retracements from a V top or a V bottom are signaling that the move is close to exhaustion. M and W patterns often begin with PBSs and PSSs, which form after less than 40% retracements. Something to take note of when you look at a PBS or a PSS. The right side then forms a reversal, starting the move of an M or a W pattern. Remember, every deep retracement will create a price void that must be considered.